Learn every day for a better life. If you're new to investing or just starting out, it can be overwhelming to navigate the different types of funds available. But don't worry, we've got you covered. In this video, we'll break down the differences between index funds and mutual funds and help you decide which one might be better for your wealth-building goals. Let's start with the basics. Both index funds and mutual funds are investment vehicles that pool money from multiple investors to buy a portfolio of stocks, bonds, or other assets. The main difference is in how they're managed and how their performance is measured. Mutual funds are actively managed by professional fund managers who try to beat the market by picking stocks and other investments they think will perform well. These fund managers analyze financial statements, market trends, and economic data to make their investment decisions. Because of the active management, mutual funds tend to have higher fees than index funds. Index funds, on the other hand, are passively managed and simply aim to replicate the performance of a market index, such as the S&P 500. They do this by buying all the stocks in the index, in the same proportion as they're represented in the index. As a result, index funds have lower fees than mutual funds, since there's less management involved. So, which one is better for wealth building? Well, it depends on your investment goals and personal preferences. Let's take a closer look at some of the key factors to consider. First, let's talk about fees. As we mentioned earlier, index funds generally have lower fees than mutual funds. This is because there's less active management involved, so there are fewer expenses to pass on to investors. Over time, these lower fees can really add up and have a big impact on your overall returns. If you're looking to keep your investment costs as low as possible, index funds are probably the way to go. Next, let's talk about performance. While it's true that some mutual fund managers have been able to beat the market over the long term, the vast majority of them don't. In fact, research has shown that over a 10-year period, more than 85% of actively managed mutual funds underperform their benchmark index. On the other hand, index funds simply aim to match the performance of the market, and because they have lower fees, they often outperform actively managed mutual funds in the long run. Another factor to consider is diversification. Both index funds and mutual funds allow you to invest in a diversified portfolio of assets, which can help reduce your risk. However, because index funds are passively managed and simply replicate a market index, they tend to be more diversified than actively managed mutual funds. This is because mutual fund managers may have biases or preferences for certain stocks or sectors, which can lead to a less diversified portfolio. When deciding between index funds and mutual funds, it's important to consider your investment goals, risk tolerance, and investment horizon. If you're comfortable taking on more risk for the potential of higher returns, mutual funds may be a better fit. However, if you're looking for a more passive and long-term investment strategy, index funds may be a better option. It's also important to consider the specific fund's track record and management team, as these can impact the fund's performance over time. Another important factor to consider when choosing between index funds and mutual funds is their tax efficiency. Mutual funds can generate more taxable events, such as capital gains and dividends, due to their active management style. These taxable events can trigger tax liabilities for investors, which can eat into their returns. On the other hand, index funds tend to be more tax efficient because they have a passive management style and fewer taxable events. This can lead to lower tax liabilities for investors and higher after-tax returns. So, there you have it. Index funds and mutual funds both have their pros and cons, and the best option for you will depend on your personal goals and preferences. As always, make sure to do your own research and consult with a financial advisor before making any investment decisions. Remember, the key to successful wealth building is not just picking the right investment vehicle, but also staying invested for the long term and avoiding emotional decisions based on short-term market fluctuations. Whether you choose index funds or mutual funds, make sure to stay disciplined and stick to your investment plan. Thanks for watching, and we'll see you in the next video. Subscribe to make your life better.